CoreLogic's latest housing affordability report is out. Is the dream of owning a home in New Zealand still within reach, or has it officially gone the way of the mower? The popular Kelvin Davidson returns to tell you the numbers, the trends, and everything else about the real estate market. Keep watching if you want to gain financial freedom faster.
Financial freedom faster. Financial freedom faster.
If you like making money rather than watching everyone else do it, hit that subscribe button and get ahead, because this is New Zealand's fastest growing real estate and investment show. Kelvin Davidson is CoreLogic's chief economist and the brains behind the latest housing affordability report. Kelvin, break it down for us. What's the biggest takeaway from the data?
Yeah, so I think really it's improved. So housing affordability has got better. I think with housing affordability, it needs to be a relative and absolute thing. So yes, you can look at the measures and say, okay, housing affordability or a mortgage payment absorbs X% of your income, but it's a bit of a bald measure. You really need that context, and you need to look at things relative to history and across different parts of the country as well. So just keep in mind that relative thing. But yes, the key point is housing affordability has improved. It's still a little bit worse than normal, but it has improved from where it was compared to 2 or 3 years ago. We've seen incomes go up, house prices come down, of course, and then more lately, interest rates come down a lot. So all of those sort of things that go into the mix of housing affordability have definitely improved. So affordability is better. I doubt many people are rushing out and saying, look how cheap it is, but it's certainly a lot cheaper than it was going back 2 or 3 years. That's for home buyers. If you look at renters, there are still definitely challenges for renters, so that's going to make it a little bit tricky. Paying the rent day to day is still absorbing quite a high share of income, which will make it obviously difficult to pay those weekly costs, but also try to save for that deposit. So definitely there's still challenges there, whether you are a renter or a buyer, but things have improved. So that's really the key point.
So there are, for your study, 4 measures of housing affordability. So can you run us through quickly what these 4 measures are, and then we can dive a little bit deeper into the details?
Yeah, for sure. So we have a straight up value to income ratio, or house price to income ratio. We've seen that the latest figure there was 7.3. The average there over the last 20 years is 6.8. So yes, we're still a little bit above average. Keep in mind on these measures that above average is worse than normal, or in other words, affordability is still a little bit more stretched than normal. So currently 7.3 versus 6.8. So on that measure, yes, affordability is still a little bit stretched. But if you go back 3 or 4 years, that measure was up at sort of 9 or 10. So things have improved a lot on that measure. Then these are at the national level. Then we have mortgage payments as a percentage of household income. For a relatively new mortgage, a sort of 80% LVR type loan, that figure currently is absorbing 46% of household income. The average there is 42. So again, a little bit worse than average, but go back sort of a year or so and that figure was 56%. So again, there's been a big improvement on that, or the number has come down. Then we've got years to save a deposit. So relating into what I spoke earlier about, I guess, for renters, it's not only paying the rent day to day, but also trying to save that deposit. There are still challenges there. Years to save a deposit is up at 9.8 still. So it does take quite a long time to save that typical deposit. The average there is 9. So again, still a little bit worse than average, but go back a few years and that figure was much higher, 12 or 13 years. So again, there's been that improvement. And then our 4th measure is rents as a percentage of income. That's currently 28% versus the long-term average of 26. And that 28% is actually a record high. So, it might not seem very different from the average, but 28% is as bad as it's been for at least 20 years for renters. So, and I think that's probably a bit of a legacy thing. Rents have flattened out in the past 6, 12, 18 months. But prior to that, there was a big boom, and that's what really pushed that ratio up quite a bit. So, yeah, those are our 4 measures. As I say, all of them are still a little bit worse than average, but they're a lot better than, apart from the renting one, all the other ones are a lot better than what they were 3 or 4 years ago as those things have turned around. So, yeah, just bringing in that relative concept again. Affordability, it's still going to be a challenge for people, but it's a lot better than it was going back a few years.
Just a reminder, your competition has already subscribed to the fastest growing property and investment channel in New Zealand. That means they're getting the insights first, making the moves first, and locking in profits while you're still debating whether to click a button. Be smart and subscribe. Those trends for those 4 key points, it looks like things are getting better or flattening, or we're not sure yet?
Yeah, I mean things have definitely got better. The big shift really for home buyers has been mortgage rates. That's been the thing that's really changed around in the past, say 6 to 9 months, sort of since July last year. That's been the thing that's really given it momentum and given it impetus. Prior to that, we had of course seen house prices come down, we'd seen incomes go up, but certainly when it comes to the mortgage payments one, and that's probably my preferred measure of housing affordability, because you look at house price to incomes, it's a bit abstract. It doesn't really mean a whole lot in the real world. What does matter in the real world is, gee, how much of my income am I using to service that mortgage? And so it's probably my preferred measure. So the big shift there has been in the past 6 to 9 months, as mortgage rates have come down from above 7 to some cases less than 5 now. So that's been the big change for people. If you're taking out a new loan, it's going to cost significantly less of your income to service that debt. So the trend on that one has been down. Probably the house price to income ratio has flattened out just a little bit in the past little while, as house prices have sort of stopped falling, and also incomes have perhaps moderated a bit too. Years to save has probably flattened out a little bit. As I said earlier, a lot lower than what they used to be, or a lot better than what they used to be. But if anything, they've probably flattened out a little bit. The mortgage payment ones has really improved as interest rates have come down, and possibly set to improve a little bit further as well. We've probably got some further falls to come in mortgage rates, and maybe the biggest falls are behind us, but there might be some further falls there, and we get a little bit of income growth, then that measure should probably improve a little bit further too. So for home buyers, it is good news. Let's not sort of beat around the bush on that. Yep, housing's not cheap by any means, but it's a lot better than it was. So affordability is definitely shifted around.
So we had a housing boom a couple of years ago, and now we've had a fallback to reality. Is the downturn over? Are we looking like we're back to growth, or not yet?
Yeah, well, I think that's a good way of summing it up. I mean, another way of kind of putting a theme around this latest housing affordability report is that it's back to the most favourable most favourable levels, I should say, since pre-COVID. So that stretch that really got applied to housing affordability through 2020, 2021, that big boom in housing, and the way that really stretched housing affordability has now pretty much all been unwound. So we're back to a position where we last were in 2019 generally. There's going to be regional elements in there, but generally I think you can sum up housing affordability now as being the best it's been since pre-COVID. So all of that shift we had in 2020 and 2021 has been unwound. I think if you look at the market right now, there are signs that it's turning around. Affordability will be part of that, but then you've got I guess just a little bit more confidence coming through, those lower interest rates. The economy is showing signs of picking up. The labour market is showing signs of, I guess, reaching a trough. We haven't seen unemployment start to come down again, but at least there's signs that it's peaking. So, I think we are looking at a housing market right now that is showing signs of turning around. We saw on our house price index for February, we saw a little bit of growth pretty much across all of the main centres. So, I think the affordability story is part of that. Like I said, it's not cheap, but it's a lot cheaper than it used to be. And so if people are just having a bit more confidence about the market, they think, we can stretch to pay that price. Whereas previously they might not have been able to. Now they can. So that's sort of just seeing that market turn around a little bit. So I think it's all pretty consistent. Not saying we're going to have a new boom by any means, because again, affordability is better than it was, but it's still not amazing. It's still a little bit worse than normal. So, I think that'll keep a bit of a lid on things. We've got debt to income ratio restrictions, still a lot of listings. So for every sort of positive in the market, I think at the moment you can probably find a counteracting restraint too. So I think, signs it's turning around, but perhaps not a fresh boom either.
Yeah, looking at this years to save a deposit, I was having a look at some of your data, and I see that go back 20 years, it was a much shorter period to save than it is now. Do you think that that's more to do with incomes or interest rates, or what do you attribute for this years to save going up 20-30% in some cases?
Yeah, it's really it's about the growth, and underlying this measure again is sort of a house price to income ratio. Really, the thing that's pushed up years to save a deposit is that house prices have outpaced incomes. So, you're just having to take a bit longer as those house prices have risen relative to incomes. It just takes that little bit longer to save. Now, one thing I guess that we can't really take into account in this measure is the expense side of things. And that's likely to be playing a role as well. Like I say, it's not part of this measure, but yeah, we've had general inflation and lots of different day-to-day costs of living. There's pressure on the expense side of the equation for people, as well as the income side. It's taking you longer to save that deposit, not only because houses have got more expensive, but also because your costs have gone up too. So that cost side of thing is part of it as well in the real world. But in terms of this measure, it really is just about that growth in house prices that we've seen over many years, and I think that's why you can't look at these measures probably in isolation either. I mean, yes, years to save a deposit has gone up. It doesn't look great. People sitting there right now thinking, gee, I start now, it's still going to take me 9 or 10 years. I mean, it doesn't look great, but also what it doesn't take into account is those lower mortgage rates. And, once you've scaled that deposit hurdle, the fact that interest rates have come down over time will sort of help with servicing the debt. So there's always swings and roundabouts in the housing market, and there's always two sides to the coin. And, these are only averages too. So someone looking at a years to save a deposit measure of 9 or 10 years, well, that's an average. People putting more into their savings, making a really concerted effort to save will get there a lot quicker than that. So, and different regional aspects too. That's a national picture. If you're buying in, I don't know, Greymouth, that average that figure might look a lot lower. So, keep that in mind too.
Just a reminder, smart investors are always ahead of the curve, and that's exactly why this is the fastest growing property channel in New Zealand. Subscribe now or enjoy watching other people snap up deals while you wonder why you're still stuck waiting for the right time. So good if you're looking at buying another house or your first house, but tenants still facing pretty significant challenges. And you say this 15 years ago, the rent to income ratio 24.6%. Now we're looking at 28.4%. A record high, working against renters. Does that make it hard for house prices to keep going up?
I mean, to some extent, if rents are high in relation to incomes, it's going to be difficult, obviously, for those renters to pay their day-to-day living costs, but also try to save for that deposit as well. So the fact that renting is expensive may be just slowing down that first home buyer purchase process a bit. Might be slowing down that transition from renting into home ownership. So yeah, potentially is a bit of a restraint on house prices. But and I suppose the other thing to point out there is that these are averages again. The average renter might not be earning the average income. They may have a below average income, yet still having to pay, in some cases, the average rent. So even though this number at the headline level is 28%, it could be significantly worse than that for individual renters. So if anything, I suspect the situation for many renters is even a little bit tougher than what these numbers suggest. But also, these numbers don't tend to fluctuate too much. And while we've said that is a record high, and that's true, it tends to have, it's tended to be around that sort of between that 24 to 28% range pretty consistently, and that average is 26. So you don't tend to see this ratio fluctuate as much as, say, the house price to income ratio or mortgage payments as a share of incomes. So renting is a more stable part of the market, but not downplaying it. It's definitely a challenge at the moment, and that might be slowing down the home buying process for some people. But also, this renting has been expensive for the past couple of years, yet we've still seen quite a few first home buyers. So people are managing to make the transition. And I guess, there's always swings and roundabouts. Yes, at the moment, might be tricky to keep paying that rent, but the buying side of the equation has got a little bit easier. So once people are in their house, servicing mortgage is a bit easier. So there's always swings and roundabouts.
And what's the impact of the supply side affecting the affordability? Is there any government policies that are making a big impact at the moment?
Yeah, I suppose over the past few years, when the construction sector has been going through a slowdown, at least in terms of new dwelling consents. But prior to that, there was heaps of dwelling consents, and we've seen a lot of new housing come in. I mean, you look at the Auckland townhouse boom, I think we're still seeing a lot of those developments being finished. So there's still a lot of new property coming on stream, certainly in Auckland, to some extent Christchurch as well. Perhaps not quite so pronounced in other parts of the country, but certainly there has been a big townhouse boom in Auckland and Christchurch. So I think that's been part of the story. We have seen housing supply ramp up over the years, and especially with population growth now slowing down, the net migration balance has fallen away. I guess that supply and demand balance seems to be in some kind of equilibrium at the moment. It's quite hard to measure, but it does feel like, if you want a house, there's one there. Supply and demand is balanced to some extent. And yeah, on top of that, right now, the new government, or relatively new government, the current government, is pushing very hard on housing supply. Look at all the measures they've brought into policy over the past couple of years. They are really trying to shift that vibe and that sort of long-term outlook around housing supply. They're really trying to get more houses coming through with opening up more land and making it easier to get dwelling consents, streamlining that whole process. So that seems pretty positive to me. The thing is, it'll take some time. These things just don't happen overnight. You just don't reform the Resource Management Act overnight, and getting councils to change their processes is going to take a while. So land supply is it's not going to be fixed overnight, but the early signs are pretty good. So you'd have to think that will help housing affordability over the long term, or putting it another way, might result in lower house price growth than we've seen in the past. So therefore keeps housing affordability in a bit more check than what we've seen historically. Then you've got debt to income ratio restrictions this time too, which I think kind of play into that mix as well. Over the medium term, certainly will tend to restrain house prices a bit. So yeah, I mean, yeah, there'll be plenty of times in the past, say go back to 2007, 08, where I wasn't here, so I wasn't doing this job. I was in the UK, but I bet there are a bunch of economists back then saying, look how stretched affordability is. It can't get any worse. House prices will be flat forever. Well, since then they've gone up. So affordability doesn't tell you everything, but I think it can tell you a little bit about sort of where the market might be headed over the long term. And so yes, affordability's improved. We still have some challenges, so that'll be some kind of restraint on house price growth. Then you add in things like DTIs, you add in housing supply, you add in possibly some tax changes around housing in the future. Don't know when and don't know what they might be, but possibly some tax changes. You start to build this story that house price growth in future could be a little bit lower than the past. Not saying it'll disappear altogether. I think we'll still see capital growth. Just there's this sense that it might be a little bit lower in future than what we've seen in the past. And stretched affordability is kind of part of that, even though hopefully we'll see more supply opened up and that will help more people into houses.
Thanks for joining us, Calvin. Now, just a reminder, this is the fastest growing investment and property channel in New Zealand. Why? Because the people who subscribe here are the ones making money while everyone else is still thinking about it. So hit that button before you get left in the dust.
More cash, passive income coming fast. Make your money work for you. Live the dream that's overdue. So don't just wait, take control. Mortgage HQ will make you bold. Financial freedom's in your hands.